I'm in my 40s. And at some point, you start asking a different question about investing. Not just how to grow your money, but how should your investments actually work for you? Should you focus on growth or income? That's where growth and dividend investing play a big role. Growth investing focuses on companies that reinvest their profits to grow faster over time. You don't receive cash today, but the value of your investment can increase over the long term. Dividend investing is different. These are companies that pay you cash regularly, just for owning them. So instead of waiting for growth, you receive income along the way. Now let's make this more concrete. For growth investing, you might look at funds that track the S&P 500. These have delivered around 10% per year over the long term. Or more growth-focused funds, like those tracking the Nasdaq 100, which have delivered significantly higher returns in the past decade, closer to the mid to high teens, although that was a particularly strong period for technology stocks. For dividend investing, there are funds focused on companies that pay consistent income. Examples include Vanguard High Dividend Yield ETF and Schwab US Dividend Equity ETF over time. These have delivered returns in a similar range to the broader market, roughly in the high single digits, with dividend yields of around 2 to 4%. So growth may deliver higher returns, but it often comes with higher concentration and higher volatility. While dividend strategies can feel more stable and provide income along the way. But here's the important insight. It's not really growth versus dividends. It's about total return. Both approaches can generate returns, just in different ways. A $100 investment, growing at 10% per year, becomes more than $250 in 10 years. That's the power of compounding. And dividends are simply one part of that total return. So what does this mean if you're in your 40s? You likely still need growth. You may have 20 years or more ahead of you. That means compounding is still your biggest advantage. But at the same time, dividends can provide stability. They can make it easier to stay invested during market downturns. And that's why many investors don't choose one or the other. They focus on building a simple, well-balanced portfolio. One that gives them exposure to the market, without overcomplicating decisions. I actually broke this down in a separate video, where I show how a simple free fund portfolio works step by step. It's a practical way to stay diversified and avoid overthinking every investment choice. Because investing in your 40s isn't about extremes. It's about building a portfolio you can stick with through different market conditions. The goal isn't to pick a winner. It's to build a strategy you won't abandon when markets fall. Like and subscribe if this helped you think more clearly about investing. This video is for educational purposes only. It is not financial advice.